On to number 5, halfway there. This is cash on cash return, one of my favorites, because cash on cash return tells you the total return on the money you have in your real estate investment. So really simple, it's how much money you're earning off your cash invested. It's an important metric because unlike other real estate investing metrics, it tells you your total return based on the exact amount of money you put in the deal, not the amount of the debt on the deal, just the cash you put in. So to get the current return on the total amount of cash in either a property or your portfolio, you take your net cash flow after debt service and divide it by the total cash you invested in the deal. So to calculate total cash in, that is the sum of the acquisition costs of the building, so your down payment, any renovations you did, any closing costs, all that kind of stuff. So essentially your initial cash in out of pocket money into the deal. So playing around with the cash on cash return can help you determine the best way to finance a new investment. So it's used when choosing between potential investments and can help you forecast returns over time based on your initial cash input. So one question I get often is, how is cash on cash return different from cash flow? And it really boils down to 2 specific ways. The first is cash on cash return is expressed as a percentage, while cash flow, as you just saw, is expressed as an amount. And number 2, cash flow shows you how much money you'll have available at the end of the day to deposit in your bank account after all expenses. Whereas cash on cash return tells you what kind of return you're receiving for the total amount you invested in that property. And that includes acquisition equity, plus any additional money that you put into the deal. So let's take a look at 2 quick examples. Example number 1, property was purchased for $50,000 down payment with $10,000 in annual cash flow after debt service. So very simply, it's $10,000 divided by $50,000 gives you a 20% cash on cash return. Not too shabby. Example number 2, property purchased for $250,000 all cash, plus $50,000 in repairs, with a annual cash flow of $25,000. Again, $25,000 divided by $300,000 gives you a 8% cash on cash return. Now, this cash on cash return is lower than the previous example because this assumes an all cash purchase. So you didn't use any leverage. You had to put in more money, so your cash on cash return is lower, but might be a safer move if you don't have any debt on the real estate asset. So now Victor's going to show us an example of an actual property's cash on cash return.
Thank you, Brad. Back to Chris's dashboard here of 5213 Kevin's Way. And the cash on cash calculation is actually one of the newer features on Stessa here. And it's still located on the dashboard just a little bit lower if we scroll down. So here with all the money in and expected income, Chris has a 19.9% cash on cash return on a trailing 12-month average. If you want to view your monthly cash on cash, you just click this little button here and it pulls out this graph. Keep in mind that this blue line is the monthly cash on cash, but we do multiply by 12 to compare to annual, apples to apples with the annual return.